Hello, my name is Donna McMillan, and today I will be talking about the external auditor versus fraud detection. I'll start with an overview of the issues, then I'll give a brief history of the external auditor's role. I'll explain what led to the passage of SOX and what it is, and how that affected the external auditor. I'll offer some other viewpoints on the role of the auditor, and then I'll wrap up with my conclusions. Fraud is still a major threat today, even in our tech-savvy world. It affects 82% of all companies, up from 75% just 3 years ago. The annual report to the nations by the Association of Certified Fraud Examiners shows that organizations lose 5% of their revenue every year to fraud. In over 22% of the cases, these losses were greater than $1 million. And unfortunately, most of those losses are never recovered. So are companies using anti-fraud controls? Well, yes, at least they think they are. The chart on the left shows what anti-fraud controls are most commonly used. 80% of companies use a code of conduct and an external audit of financial statements to try to deter and detect fraud. This is followed by internal audits, management certification of financial statements, external audits of internal controls, and so on. But when you look at how fraud is actually detected, as shown in the chart on the right, you'll see that tips discovered the most cases of fraud. 40% of fraud cases were detected by tips from employees, internal hotlines, and things like that. Internal audits are a distant second at 15%, followed by management review, and then by accident. 7% of fraud cases were discovered by accident. And then way down at the end of that red arrow, you'll see that external audits detected only 4% of the cases. More were found by accident. In 1993, the American Institute of CPAs said, "The public looks to the independent auditor to detect fraud, and it is the auditor's responsibility to do so." So, should the external auditor be doing a better job at detecting fraud? Well, my research shows that no, the external auditor is limited in what they can do and should not be relied upon as a primary anti-fraud control. After the stock market crash in 1929, the Securities Act of 1933 was passed to protect investors and create laws against fraud. It required companies to have an audit of their financial statements by independent accountants. Accountants followed the standards and ethical guidelines set by the AICPA. Then came the huge corporate accounting scandals that made headline news in 2001 and 2002. Billions of investor dollars were lost due to fraud from companies like Enron and Tyco and WorldCom. The U.S. government stepped in again. Senate committee hearings found that there was inadequate oversight of accountants. They were basically being self-regulated by the AICPA. There was a lack of auditor independence. For example, auditors were found to have lucrative consulting jobs for the very same companies they were supposed to be auditing. And there was weak corporate governance. For example, board of directors didn't have audit committees that had the appropriate experience or that were truly independent from management. Congress easily passed a bill that became, in the words of Senator Paul Sarbanes, the most far-reaching securities legislation since the original Securities Acts of 1933 and 34. The Sarbanes-Oxley Act, known as SOX, was passed in July of 2002. It established the Public Company Accounting Oversight Board, standards for external auditor independence, and increased corporate responsibility. It was widely praised for improving investor confidence and the accuracy of financial statements. But it was also criticized for being way too costly, especially for small businesses. Section 404, Assessment of Internal Controls, was the costliest to implement. It required that the auditor not only report on the accuracy of management's financial statements, but also on the effectiveness of their internal controls on financial reporting. So in 2007, the PCAOB issued Auditing Standard Number 5 to reduce cost. It limits the scope of the auditor's review and implements a top-down risk-based approach. But then, annual inspections by the PCAOB in 2013 showed that significant problems had developed in the audits of internal controls. The ACFE reports to the nation also show a decline over the years in fraud detection rates by external auditors. In 2002, 11.5% of fraud cases were discovered by external audits, but by 2018, that rate was down to just 4%. So what happened? According to PCAOB reports, auditors were improperly applying that top-down approach required by AS5. Also that they had a lack of understanding of management controls, and they failed to test controls for all the relevant significant accounts. AS5 had been designed to reduce cost, but in doing so, did it also sacrifice quality? Switching to a risk-based evaluation of internal controls made it harder for the auditor to identify all the pertinent material weaknesses. Despite these hardships, some in the profession firmly believe that auditors have a primary responsibility to detect fraud. They cite the 2002 Auditing Standard 1001 that states, "The auditor is required to obtain reasonable assurance that frauds which materially mistake financial statements are detected." There's also the 2007 PCAOB release that states, "The detection of material misstatement in financial statements caused by fraud is an essential element of an audit." But is this really reasonable, especially under the constraints of today's cost and regulations? So what are some better ways to deter and detect fraud? External auditors themselves have recommended the following anti-fraud controls: surprise internal audits, job rotation among employees, fraud training for managers and employees, and anonymous tip lines. The ACFE has a similar list of proactive detection measures that they have shown are effective. These are internal hotlines, surprise audits and spot checks by management, and training all employees to spot fraud. So in conclusion, I believe that the external auditor, who does serve a very important role in protecting the American investor, is inefficient at detecting fraud. The primary responsibility to deter and detect fraud falls on management. When management creates strong internal controls on financial reporting that are tested annually by the external auditor, businesses will better deter and detect fraud.